Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B, and today we're going to be talking about partnerships and partnership accounting. Before we begin our discussion on partnership accounting, I'd like to call your attention to where we are in the course. So we are currently in week 6, and what that means is we have a discussion and we have a quiz due on October 3rd. So please make sure that as you're listening to this video and taking notes and all that great stuff, that that information will be very helpful for you as you take care of the 11 discussion and the 12 quiz. So without further ado, let's go ahead and jump into partnerships. So think of business structures in this chapter. What is a partnership? A partnership is between two or more individuals that own a business. That's a partnership. Two or more individuals that own a business. How do we account for these partnerships? Well, a lot of it has to do with the percentage of ownership, and a lot of that is based off of what each individual partner brings into the business through their equity. So as you recall, in previous chapters, we discussed the concept of what we call paid-in capital. Paid-in capital is the account for each partner that represents the amount of equity that each partner brought into the business. And typically, the way that it works is we would attribute a percentage of ownership based on the amount of equity that each partner brings into the business. And so what we'll do is we'll first talk about the characteristics of partnerships and other types of organizations. We'll jump into return on equity. We'll talk about journal entries we make for partnership formation. We'll talk about allocation of income and loss between partners, admission of new partners, withdrawal of partners, and we'll prepare for partnership liquidation, which is the end of the partnership. So let's talk about the characteristics of a partnership. There are a couple of key components with respect to partnership organizations. In most cases, partnerships are part of it's basically a form of a corporation, right? So you have a sole proprietorship, partnership, C Corp, S Corp, limited liability, limited partnership. These are forms of businesses, formations of businesses, and they represent how the business was created based off of the articles of incorporation. So let's take a look at a partnership specifically. It's a volunteer association relationship between partners. There's typically a partnership agreement involved that identifies the limitations and the scope of ownership between partners. Partnerships usually have a limited lifespan because individuals only live for so long. There's unlimited liability between partners. What that means is that both partners have the ability to be sued, including their personal assets. There's typically co-ownership of property, plant, and equipment. So property, plant, and equipment, which are your fixed assets, are usually co-owned between two or more individuals which are involved in the partnership. There is mutual agency between the partners, mutual taxation between the partners. And so all of these elements are commonly involved in the formation of a partnership. So let's look at partnerships as they are incorporated. So there's this thing called the limited partnerships. Limited partnerships assume management duties and unlimited liability for partnership debts. In other words, the individuals can be sued up to their personal liability. And partners have no personal liability beyond the amount that is invested. That's what makes it limited. So in other words, the individual partners can be sued up to the point of their investment in the corporation. In other words, if the partners are sued, the liability ends with the business. It does not go to their personal assets like their house or their car, things that are owned by them, not by the business. With respect to limited liability partnerships, there's protection against malpractice and negligence claims, typically through insurance. We call this limited liability insurance through insurance umbrellas. We'll talk a little bit about that. And most states hold partnerships personally liable for partnership debt. So what that means is the partners are liable up to personally liable for the business's debts. S corporations have 100 or fewer owners. They're treated, their partnership is treated based off of their income tax purpose, and the C Corp has limited liability. The limited liability corporations, members have limited liability as they would in an S Corp or C Corp. And the limited liability typically has a limited lifespan. So these are just different types of organizations and their characteristics within partners. How does one select the business formation, whether it be a general partnership, limited liability partnership, LLC, C Corp, or S Corp? A lot of it has to do with the liability, which is being discussed, and of course, taxation. So we see from this that the limited liability for limited partnerships is limited. LLP, LLCs, S Corp, and C Corp has limited liability, but general partners do not. Limited liability is an important thing to consider when you're forming a business because you want to ensure that your personal assets are protected against any type of lawsuit. Business taxation, also very important to understand. What this means is where it says no, which is for general partnerships, limited partnerships, LLPs, LLCs, and S Corps. It says no there because that means the individuals are taxed based off of the business earnings. Whereas a C Corp, the business is its own individual, it's its own entity, and therefore the business itself pays its own taxes, not paid by the individual owners. So these are things to consider as you're forming a business, especially a partnership. So what happens when the partnership is first formed? Partners can invest assets and liabilities into a partnership. Earlier, I had mentioned that the typical percentage of ownership for partners is represented by the assets they're bringing into the business, the property, plant, and equipment. Which is oftentimes the case. Partners can bring in their property, plant, and equipment. They can bring in other forms of assets and also liabilities. So if we bring in a piece of machinery and there is a current loan attached to that piece of machinery, then we would bring the loan into the business as well. The assets and liabilities are recorded at market value when they are contributed to the business. The asset contributions increase the partner's capital, which is the paid-in capital, and withdrawals decrease in the partner capital account. We'll talk about that. And the net income or loss is allocated to the partners according to the partnership agreement. That's typically based off of the percentage of ownership. So here we have an example of partners entering the business, and these entries represent the formation of the business. So on January 11th, we have two partners. They decided to organize a business called Boards. One partner's initial investment is $7,000 in cash, $33,000 in boarding facilities. I imagine it's like horse boarding, probably, is my guess. And there is a note payable of $10,000 on that facility. So let's, and then the other partner brought in $10,000 in cash. So let's identify those two separate entries. The first one is the cash coming into the business, the building, the note payable, and then the remaining balance is allocated to the owner, right, as a form of paid-in capital. So we have cash. We debit cash coming in. We debit the building coming in. We credit note payable, the note coming in, and we credit the paid-in capital account for the partner coming in. And so these are the type of entries that we would make as partnerships begin, as a business begins, right? And the second partner we have is bringing in cash. So we debit cash, 10,000, and we credit the paid-in capital account for the second partner. And every time a partner comes into the business, it's always going to be a separate journal entry. When a partnership is organized, it's important for the partner withdrawals to be debited into their own separate withdrawals account. In other words, we need to ensure that our partners maintain separate accounts. And this is always going to be critical because money coming in, money going out from the partners needs to be properly accounted for, especially when it comes to taxation. The partners' capital accounts are accredited or debited depending on the shares of net income coming in or the loss going out, and when the accounts are allocated at the end of the period. So in other words, when there is a net income, the paid-in capital account is credited. If there's a net loss, it's debited. Net income becomes net loss, and therefore it's debited. That's why you see the parentheses for number 2. Each partner's withdrawal accounts are closed to the partner's capital account. And this part is actually done through the statement of owner's equity. The statement of owner's equity at the end of the accounting cycle, as you may recall, we have net income minus withdrawals equals owner's equity, ending balance owner's equity, and that is the common formation of that. Because remember, under equity, that represents what the owners own, right? And another way of thinking about it is assets minus liabilities equals equity. That's another way of writing the accounting equation. So let's take a look at the allocation and recording of net income or loss between partners. Partners are not employees of the business, but they are owners of the business. So they do not have salaries. They don't have salaries because they're not employees of the business. They are owners. So instead of salaries, they take owners' withdrawals or owners' draws. The profits and losses of the business at the end of the year are divided up between the partners, and it's typically agreed upon some type of ratio, the ratio being their percentage of ownership in the business. And it's typically based off of the amount the paid-in capital into the business represents their shares of ownership. So the allocation is based off of the stated ratios, capital balances, in other words, how much they brought into the business, and the services paid-in capital and stated ratios all together. And that's how we determine the percentages of ownership. So let's take a look at our example. We have our 2 investors, Zane and Perez. So at the end of their first year in business, the business earned a net income of $60,000. So with that net income of $60,000, the owners share in the profits, right? And so this profit sharing is based off of their percentage of ownership. So earlier we had identified the amount of capital that both Zane and Perez brought into the business. Perez brought $10,000 in cash in, Zane brought a building plus cash. And so based off of their asset allocation brought into the business, we can say that Zane has 2/3 of the business ownership and Perez has 1/3 ownership of the business. Now, why is that, you might ask? Now, remember, Zane brought in cash plus a building. So it's safe to say that Zane owns most of the business. So in this case, 2/3, and Perez owns 1/3. And again, this is agreed upon at the formation of the business. And that could change over time based off of their paid-in capital. If Perez decides to bring more money in later on, of course, that ratio would change. So the business earned at the end of the year $60,000 in profit. So let's go ahead or in income. And so let's go ahead and divide that across the partners. So what we do is we take the $60,000 of net income and we multiply that by their percentage of ownership. So Zane has 2/3, so 2/3, which is 66% of the business. So 60,000 times 66% or 2/3 is $40,000. So $40,000 of capital is allocated to Zane. So we debit income summary, 60,000, credit paid in capital to Zane, 40,000, credit paid in capital to Perez, 20,000, which is of course the difference. And that, of course, how do we come up with 20,000? You might be asking. So the net income 60,000 times 1/3 or 33% is 20,000. So in looking at the percentage of ownership, it's safe to say that that Zane has 75% of the business ownership and Perez has 25% ownership of the business. Well, how do we find this? How do we discover this? It's based off of the contributions that each partner made to the business. And then over time, as the income gets added in, that will also have an influence on the ratios. So so Zane started with $30,000 brought into the business. It was a building plus some cash. So, so the building plus the cash minus the debt. So that gets us to 75%. So the allocation of the income based off of capital balances. So if Zane owns 75% of the business and the net income is 60,000, that means that we would allocate $45,000 of that income to Zane and 15,000 to Perez based off of Perez's 25% ownership. So we would debit income summary 60,000, credit Zane 45,000, credit Perez 15,000. And so looking at the differences between the ratios, this first ratio represented 33% to 66%. This ratio is 75% to 25%. And again, it's a lot of it's based off of the actual partnership agreement. So, okay, I own 75%, you own 25%, based off of your balances. So Zane and Perez have the partnership agreement with the following conditions. This is when they drew up the agreement. So Zane receives $36,000 annual salary allowance, and Perez will receive an allowance of $24,000. The reason why they call it an allowance is Zane and Perez are not employees of the company, so it cannot be a salary expense. These are typically done as withdrawals on the business. Each partner is allowed an annual interest of 10% on the beginning capital balance, and any remaining balance of income or loss will be allocated equally. In our example, we have a net income of $70,000. So if we have a net income of $70,000, each partner has a draw or salary. Zane has 36,000, Perez has 24,000. So 70,000 minus 36 minus 24 gives us a remaining balance of 10,000. Based on the balance of 10,000 and their percentage of ownership in the business, we can then allocate the interest. The interest we had said would be 10% on the remaining balance divided equally. So 30,000 times 10%. Remember, 30,000 is what Zane brought into the business. Perez brought 10,000 into the business. So 30,000 times 10% is 3,000 interest to Zane, 1,000 interest to Perez. So 10,000 minus 4,000 equals a remaining balance of 6. And the 6,000 is divided equally among the partners, 3 and 3. So the income to Zane would be 42,000. Income to Perez would be 28,000. Now, what if there was a net income of only 50,000? So the net income for the next year is lower. It comes in at 50,000. Well, they both have salaries that they have allocated to themselves. Zane 36, Perez 24. That would give us a balance of negative 10,000. Okay, so obviously that's relatively problematic because the net income came below their salaries, and so therefore we ultimately will have a net loss. Then there's interest that they've both allocated, and all this information is based off of the articles of incorporation for the partnership. So Zane gets 10% of the initial investment of 30,000. So 10% is 3,000. Perez gets 1,000. So now our remaining balance is negative 14,000. Now, the allocation for both either the profit or the loss is allocated to both partners equally. So what that means is that both Zane and Perez will have a negative $7,000 allocation to share in the loss, which means that Zane will have an income of 32,000 and Perez will have an income of 18. So based on that example, we can see those changes. So what about cash withdrawals? Cash withdrawals, as we had said earlier, the owners have the rights to the profit of the business, and they can take withdrawals for themselves as agreed upon. So during 2019, Zane withdrew 20,000 from the business. Perez withdrew $12,000 from the business, and the income for the year was 70,000. So in looking at our balances in our income statement, so if we had 70,000 based off of their percentage of ownerships, the salary allowances. So we have total net income of 70,000. Then you have so we add up our salary plus our interest plus the allocation. So 36 plus 3 is 42. 24 plus 1 plus 3 is 28. Less any withdrawals. Zane withdrew 20,000, Perez withdrew 12,000. So the ending capital, paid in capital of Zane has 52,000 and Perez has 26. So what happens when new partners come into the business? Let's say Zane and Perez are looking for a new partner. They want a new partner to come in. Well, they would need to form a new partnership agreement by modifying the existing partnership, dissolving it, and making a new one. The new partnership should be immediately formed. The new partner acquires partnership by either purchasing shares, purchasing part of the business from the existing partners, or investing their own assets into the partnership. The new partner can purchase a partnership interest directly from the existing partners. For example, okay, Mr. Perez and Mr. Zane, I'll give you both $20,000. Okay, so that means that I would have the rights to $40,000 of assets in the business. Okay. So the cash goes directly to the partners and not to the partnership itself. That's one way of investing into a business. So Mr. Rashid comes in and says, "Hey, existing partners, I want to join you guys." So the other two dissolve their existing partnerships, form a new one with Rashid. Now, initially, or at the end of the old partnership, Zane had 52,000, Perez had 26. Rashid makes an agreement to purchase part of Perez's ownership in the business. So how did that work? Well, Rashid paid Perez $13,000 in cash for shares of ownership in the business from Perez. And so, and looking at that reallocation, Zane still the same, 52,000. Perez is 13,000 less because Rashid purchased the part of ownership from Perez. So Perez has 13,000 and Rashid has 13,000. So the the allocation of the new partner, we debit Perez 13,000 to reduce Perez's paid-in capital, and we credit Rashid's paid-in capital to increase Rashid's paid-in capital to represent the new formation of the partnership. So the new partner can gain interest by contributing assets into the business, saying, "Oh, Rashid comes into the business and says, hey, you know what? I got some equipment, I got some cash, I got some whatever, right? Put it into the business, and they can earn interest in the business that way. New assets will increase the partnership's net assets. So after the new partner comes in, both the assets and the equity, of course, will increase. So Rashid comes in, he already bought some stuff from Perez, and then goes, okay, I'll come in, instead of buying it from Perez, I'll just invest my own cash into the business. Okay, $22,000. Zane's still at 52, Perez at 26. Rashid comes in and goes, hey, I'll buy into your business. I'll give you cash, 22,000. Great. So the total equity increases from 78 to 100,000. Zane's at 52, Perez at 26, Rashid's at 22. So we debit cash 22,000 to that's what Rashid's pumping into the business, and we credit Rashid's paid-in capital 22,000. What about bonuses? Bonuses work very similarly with respect to partnerships and corporations, where bonuses are paid out to the owners of the company. When there's a new partner comes into the business, that form of bonuses would change based off of the investments made by the new partner. So let's take a look at an example. On January 4th, Zane and Perez bring Rashid into the business. He invested $42,000 in cash into the new partnership. Rashid receives 25% ownership in the business, in the new partnership. So anytime that there's a bonus, the bonus is agreed upon by the existing partners and shared equally. So Zane and Perez already brought in 78,000. Rashid comes in with 42,000, bringing the total partnership equity to 120,000. Rashid's ownership percentage is 25%, which means that Rashid's equity balance is 30,000. So let's say Zane and Perez agree to accept Rashid into the partnership with his investment of 42,000 in cash. Rashid will receive up to 25% ownership of interest in the new partnership. This bonus is attributable to the existing partners and is shared equally. So we debit cash 42,000 to increase the cash. We credit Rashid's paid in capital $30,000. We credit Zane and Perez by $6,000 equally, 12 and 12. And this records the admission of Rashid and bonuses paid to the existing partners. So you might be asking, well, why did the existing partners get bonuses and not the new partner? Well, in order to accept the new partner, the agreement between the partners was, we'll take Rashid in, we'll reduce his paid in capital, and the existing partners will give themselves a bonus to accept Rashid into the business. So that's why that $12,000 of capital was distributed to the existing partners as a form of a bonus. It's part of the agreement. Sometimes the partners will agree for all three to receive a bonus. And then, that happens from time to time as well. And again, it all depends on the agreement that's written up between the partners. So let's say Rashid brings $18,000 into the business in cash and receives 25% ownership in the business. So total partner equity is $96,000. Rashid's 25% would mean that Rashid's equity balance would be $24,000. And this is the journal entry for that. So debit cash $18,000, credit Zane, credit Perez $3,000 apiece, based on their forms of shares of ownership. And credit Rashid's paid in capital $24,000 based off of the bonuses. What about when a partner leaves the business? Partner says, you know what, I'm done here. I'm going to retire. I'm going to go on and do my own thing, whatever. So the partnership can be paid out through withdrawals. Partner can sell their shares of ownership or interest in the business to another partner or to another person, or the partnership can be distribute the cash and other assets to the existing partners or to the withdrawing partner, depending on the articles of incorporation, of course. So let's say Perez says, hey, you know what, man, I'm done here. I'm going to take some cash out of the business, and y'all can do your thing, okay? So the partners share of income and loss, they share income and loss equally. Perez receives $38,000 in cash upon withdrawal from the partnership as a part of the agreement. So debit Perez paid in capital, credit cash. So we're paying Perez cash and we're dissolving his shares of ownership in the business. And he's not getting a bonus. Well, sometimes you can get a bonus, right? So let's say there's a bonus involved, or there's not a bonus involved. It depends on the shares of ownership, how it's structured. So let's say Perez is out. So 38,000, and Perez is to receive 34,000 in cash when he leaves. Okay. So we debit 38,000 capital for Perez. We credit cash 34,000, and Zane and Rashid split the difference. And this is because there's a bonus given to the remaining partners. Again, a lot of it depends in the structure of the partnership. Let's say there's a bonus to the withdrawing partner. So Perez, they're like, hey, Perez, thanks so much for sticking it out with us. We'll give you a bonus as a parting gift or whatever, right? So the partners agreed to give $40,000 in cash to Perez. So debit Perez is $38,000 investment into the business to withdraw the business. Zane and Rashid are giving Perez the bonus. $1,000 comes from each, and we credit cash $40,000. What happens if one of the partners dies? And the partnership, of course, will be dissolved. The estate of the partner who is deceased will receive their equity. The partnership agreement should have provisions in the event of a death. So the provisions usually require the closing of the books to determine the income or loss at the end of the previous period and determine the record of the current market value of the assets and liabilities. And of course, then the settlement of the deceased partner in the estate can involve selling the remaining equity of the business to the remaining partners, or it can involve the withdrawal of assets. And a lot of this is determined by the partnership agreement. What happens when a partnership liquidates? In other words, we're going to shut down the business, we're going to retire, we're going to just go out of business, whatever, right? So typically it involves 4 steps. We sell the non-cash assets, sell the property, plant, and equipment, sell the whatever. Then there will be a gain or sale on the liquidation based off of the income and loss agreement. All the partners pay the liabilities and distribute any remaining cash to the partners based off of their capital balances. What if there's no capital deficiency, which means all the partners have 0 credit balance on their capital accounts? Let's say the 3 partners decide to liquidate the business, and the only outstanding liability is an account payable for $20,000. So prior to the liquidation, the balance sheet looks like this. We got $178 in cash, $40 in land, accounts payable is $20. Zane has got $70, Perez got $66, Rashid's got $62. So let's start liquidating the business. So we'll sell the land. We got $46,000 in cash from the sale of the land. The original land investment was $40,000. So we debit cash $46,000, credit land $40,000 to reduce the land account to 0. And then we credit gain from liquidation, which is basically like the saying that's the gain on the sale of an asset is $6,000. Then we debit the gain of the sale of the asset or liquidation of $6,000, and we credit our partners. We allocate it equally. So $2,000 a piece goes to each partner based off of the sale of the land. Again, it all depends on the agreement, right? Then next thing we got to do is pay our bill. So debit, accounts payable, credit cash, pay the bill. And then once the bill is paid, of course, there's going to be a remaining balance of cash, right? So we had cash coming in from the sale of the land. We got, and then we have cash going out from the sale. From the payment of the bill. And so we have a remaining balance of cash of $204,000. Now, based off of the percentage of ownerships or the remaining balances that each partner has, we will debit their remaining balances. So debit Zane 72, debit Perez 68, debit Rashid 64 to 0 out their accounts. And then we credit cash to 0 out the cash balance. And that's how we dissolve a business. When there's a capital deficiency, it means one of the partners has a debit balance on their account. So that means that they would not be typically eligible for any type of remaining balance, with the exception of liquidation, in order to get them back to either a credit balance or to a 0 balance. Let's say there's a deficiency. One of the partners is upside down in their paid-in capital for whatever reason. So what would happen is that partner would actually put cash into the business to get them up to a zero balance. And so in this example, Rashid was upside down. So Rashid contributed $3,000 in cash. We would credit Rashid's account $3,000 in cash to get Rashid up to a zero balance. And then the remaining amount of cash in the business would be distributed across the partners. So 19,000 will go to Zane, 8,000 will go to Perez, and then we credit cash 27,000. So based off of this example, in a deficiency situation, the gains and losses are distributed evenly. So Rashid's cash, in order to satisfy the negative equity, would go to both Zane and Perez, and Rashid's balance would be zero. So we would debit Zane and Perez the $1,500 to represent Rashid's paid-in capital of $3,000. And then we would debit Zane and Perez their remaining balances and credit cash, and that would dissolve the partnership. Okay, so a couple computations I want you to understand, a couple ratios. One's called the return on equity. The return on equity is the partner's net income divided by the average partner equity. And what this ratio shows us is what each partner would expect to receive at the dissolution based off of their return on the equity. So it's what they would expect to receive. And that, my friends, is the conclusion of partnership accounting. As always, if you have any questions, comments, concerns, if you need help, if you need anything at all, you can call me, email me, set up office hours. I am here for you 100% of the time. So whatever it takes, I'm here for you. At the conclusion of this recording, please remember that you have a Chapter 11 discussion and a Chapter 12 quiz. So please make sure that you complete both of those assignments by this Sunday night. So as always, please remember to stay safe, wash your hands, do the right things, and I will see you all again next week. I sincerely appreciate your time, patience, and understanding. Thank you all so much, and I'll see you again next time. Thank you. Bye-bye.